Hello and welcome to this video on gearing. So in this video we're going to look at the gearing ratio. We're going to try and understand it, be able to do the calculation and interpret the result. So gearing is part of what we've been looking at here, which is ratio analysis. And ratio analysis is used to assess a firm's financial performance by looking at the statement of comprehensive income and the statement of financial position. We've looked at liquidity ratios, the current ratio, the asset test ratio. We've looked at profitability ratios. And now finally we're going to look at gearing and the gearing ratio. The gearing ratio measures the percentage of total capital employed in a firm that comes from either internal sources or external sources. Internal sources are from the owners of the business, so share capital and retained profit, so effectively total equity, and external sources are the non-current liabilities, the debts or the loans that have come from banks. So we're looking at the balance here of all the money that's been used to operate the business, the capital employed, how much of it is coming from internal finance, how much of it is coming from external finance. And this will help us, this percentage will help us answer questions such as, is the business able to meet interest payments on loans? If it's predominantly financed through long-term loans and external finance, then this is going to be more difficult for the business in the future. Is the business going to be able to repay the amount borrowed? Again, if it's a lot of external finance, it's going to make it harder. Is the business in a position to take out additional loans? If they already have a lot of external finance compared to internal finance, it's going to be harder to take out additional. So we calculate the gearing ratio of a firm using the following formula. We look at the non-current liabilities compared to the capital employed, and it's a percentage, so we multiply by 100. Non-current liabilities divided by capital employed multiplied by 100. And this gives us the gearing ratio. Remember that capital employed is the non-current liabilities plus the total equity. So if we take some information from the statement of financial position, the share capital, the retained profits, the non-current liabilities, the total equity, the share capital and the retained profits, added to the non-current liabilities gives us the total capital. So the total capital employed here, both business A and business B, is 1,000. They're the same size. But the makeup of where that money has come from is different between business A and business B. So if you were to have a look at the gearing of the two companies, business A's gearing is 20%. The non-current liabilities, 200, are 20%, 200 over 1,000, of the total capital employed. For business B, the gearing ratio is 60%. There's a lot more debt in business B than in business A. 600 out of the 1,000 of capital employed within the business is from long-term loans. So we would say that business B is more highly geared than business A. So here's our maths moment. If you were to be asked to calculate the gearing ratio for this particular business, we can see here an extract of statement of financial position. We need to remember the formula is non-current liabilities divided by capital employed times 100. So where are our non-current liabilities? They're 600, and for the purposes of this we ignore the minuses, 6,000. And our capital employed is the total equity, 11,235, plus the 6,000. So here's our formula. We find our information, perform the calculation, and the gearing of this business is 35%. That tells us for every £1,000 that's been invested in this business, £350 has come from long-term loans. So how do we interpret this result? Well, we would say that a business is highly geared, has high gearing, if more than 50% of the capital employed comes from loans. We have a large amount of loans compared to money from shareholders or from retained profits. We would say that a lowly geared business is less than 25% of the capital employed is from loans, a small amount of loans compared to the share capital, the total equity. So if you have proportionally more loans than equity, the business is more vulnerable to an interest rate rise. However, if we have proportionally more equity than loans, then maybe we're missing out on growth opportunities that we could take advantage of if we were to take out loans in order to fund that expansion. So a highly geared business shows that a firm is maybe willing to take risks, take out big loans. However, if profits fall, there may be difficulty keeping up with loan repayments. A highly geared firm can show that it's a firm that's willing to expand and take advantage of growth opportunities, which may lead to higher profits in the future and potentially increased dividends. High gearing is less risky when the economy is growing, but if there's a recession, a highly geared firm could be very risky, because if their revenues decline, their profits decline, they might be unable to pay back their loans and run the risk of going insolvent or face liquidity issues. A lowly geared firm may show that the firm is risk averse. However, if profits fall, the business is not going to have any problems, or less likely to have problems, meeting any loan repayments. A lowly geared firm always has the ability to take out additional loans if required to fund new projects. So lowly geared firms may be able to increase their gearing in order to take out money to fund new projects. Low gearing is less risky when the economy is slowing down or entering recession. An acceptable level of gearing, you must remember this, an acceptable level of gearing always depends on the nature of the business and the industry in which it operates. Generally speaking, the more consistent the cash flow in an industry, the more highly geared that business might be. So in this video we've looked at the gearing ratio, we've looked at understanding, calculating and interpreting the gearing ratio. That's it. Thanks very much for listening.